All right, let's crunch the numbers where adjustments to lending rates following policy changes by the Central Bank of Kenya continue to face delays as banks comply with Section 44 of the Banking Act, which requires due process before interest rates are altered. Lenders say rates should ideally adjust immediately when the Monetary Policy Committee changes the central bank rate. But consumers' protection rules mean the transmission is not always instant. The banking sector now plans to develop a new adjustment framework by June to balance faster rates changes with protection for borrowers.
Banks say the current legal framework requires them to follow regulatory procedures before changing lending rates, even when the central bank rate is adjusted. Under Section 44 of the Banking Act, lenders must ensure changes do not unfairly affect borrowers, meaning rate adjustments may take time before being reflected in loan pricing.
At one time, we spoke about a currency of 156 for the shilling to the dollar. Global inflation was much higher. In 2023, it was more than 8.7% at some stage, and private sector credit in our market had briefly contracted to minus 1.1%.
Industry players say this slows the transmission of monetary policy decisions to the market, even though the intention of the law is to protect consumers from sudden increases in borrowing costs.
That is just that transformation and shift. We get a lot of feedback from clients. NPS measures your net promoter score, what clients feel about the service levels, and I would say especially for consumer and commercial banking.
Banks are now increasingly adopting the Kenya Overnight Interbank Average Rate (KESONIA) as a reference point for pricing loans. The discussion on interest rate transmission comes as Stanbic Holdings reported a 13.7 billion shilling net profit for the year ended December 2025, maintaining profitability despite declining interest rates. Hibak Saeed for TV 47.